Welcome to the Financial Architects Home Run Podcast. Baseball season is around the corner. I'm Evan Makovsky, your host, and it's my pleasure, like always, to have partner and chief investment officer Larry Steinberg on the program. Larry, obviously, it's been an eventful couple months for you. How is everything after the fires and the other challenges that you have faced?
I feel overall very, very lucky. It could have been a lot worse for me and my family. Literally got houses on my block that are gone, and it looks like it's just going to take forever for things to recover around here. Things are moving at a glacial pace. And, I don't think things are going to be rebuilt, even started to be rebuilt for years and years and years. So, not only do I feel lucky that my house was saved, but I feel very lucky that I live in Sierra Madre, which is this small little, mountain community that's right above Arcadia and next to Pasadena. The fire started in Pasadena, the Hastings Ranch section, we're in Eaton Canyon, and it went through Pasadena, Altadena, and Sierra Madre, and we got by far the least of it in Sierra Madre, and I credit that to the fact that Sierra Madre has its own fire department, which pre-deployed into the areas where the risk was highest, and we have our own water company, and our water didn't run out. So when houses on my block were burning, there's video of the fire engine being in front of my house, and it shut it down and saved my house, right? But they had water to fight it with. In Pasadena, Altadena, and also all the fires in the Palisades in Malibu, they didn't have any water. The water ran out. It's pretty hard to fight fires with no water, especially when the winds are so high. You have no air, air elements to drop water and chemicals. So feeling very, very lucky, and I'm feeling really grateful that, I live in a community where, they had their stuff together, right? The fire department did its job. The water department did its job. Police department did its job. And we were very, very lucky that we got, it a lot, we didn't have close to us the problems that we're looking at, just, literally a few blocks from here.
So getting to business, Larry, we're 2 months into the Trump administration, and it has been an eventful 2 months. Politics aside, what is your take on how investors should be positioning themselves going forward?
Well, I think that, there's certain economic realities that are just there, right? We have massive government debt levels, and that's just not the federal government, that's state and local municipalities. They all, and there's a very big carry cost to that, to that debt. And there's repercussions from that. So just because you change the guy in charge, or technically in charge, doesn't change those realities. And it's not like you can move things around. I mean, economies and markets are giant ships, right? And they turn very, very slowly. And even, you're putting all your effort into trying to get it to turn, it doesn't turn very fast. Anybody that's been on a boat understands that. There's no real brakes. You just have to control how you're moving forward and try to pivot. And I also think that, as much as they think that the Fed can magically lower interest rates by lowering Fed rates, what we've seen is the exact opposite. They've lowered the interest rate, but the Fed has, but the interest rates that the people actually have on loans to pay out, and also on treasuries, which are more closely interrelated, are still high, right? I mean, so there's nothing they can do to magically bring the interest rates down automatically. I mean, they have to over time, and they're going to try to, but they can't. The Fed just isn't going to magically, lower interest rates and solve that problem. And I also think that, we got marginal improvements in inflation, and everybody's beating their drum. All the Trump people like, see, we told you, eggs are down, inflation is slightly lower, we're on the right path. I don't think that's going to hold. I think that the fundamentals of the economy are going to keep inflation up for a while, because there's just too much going on that is inflationary that is going to, that's going to happen. It's just kind of reality, bigger picture, looking at markets like, okay, we're going to have inflation. We're going to have higher interest rates. and we're going to have this big overlying debt problem, not just in the government, but also there's a lot of zombie companies out there whose balance sheets are off, and there's a lot of real estate off there whose capital stack is off, and they're counting like desperately to a lowering of interest rates to salvage them, and I just don't think it's going to happen. So I think there's a lot more under the water, under the covers that is negative right now, and you got to be aware of that, and you got to avoid it, right? The other thing I think is happening is that we've moved in the country over the last 20, 30 years to very large amount of passive investing. That means, there's indexes picked, and then rather than a fund manager or somebody saying, hey, I like this stock or I like that stock, it's just they buy all of the stocks in the index, without regard to which ones are good and which ones are bad. The whole solution was they're saying, hey, passive investing, is going to, and keeping costs down is going to be a magic panacea to help people. And I think that the problem with that theory or that thought is that it works to a great degree as long as there's still a lot more active managers than there are passive managers. Therefore, the passive managers can kind of piggyback on the active management and get returns because the active managers are looking at like the reality of these companies, and the passive managers can therefore kind of piggyback, like I said. But right now we've passed the point where more money in this country is indexed rather than actively managed when it comes to the stock and bond markets. And that creates a situation where there's a lot of what I call, or, and other people call index arbitrage, right? Great example, a company is going to be going into one of the indexes. One of the reasons it goes into the index is because it's just performing better. So you got a lot of hedge funds and people behind the scenes that are pumping that stock. They want to get it into the index because once it's in the index, then there's all this automatic buying that comes behind it, right? And once all this automatic buying comes behind it, right, then you can kind of just take a ride on the ship, right? You get it into the index, and there's $1 trillion in that index, and it's going to be 1% of the index. Well, now there's all that forced buying, right? There's all the indexes, the index trackers that are going to do that. So these hedge funds behind the scenes are playing arbitrage off that. They pump stocks up, and then they push them out into the index. The problem is that will and can unwind, right? What happens when, all right, one of the stocks that goes in there has something go on in its corporation that causes selling, right? Well, then it starts, the active people sell it, right? Then if percentage of the index goes down, and then the index starts selling it, right? And so a lot of stocks can get pushed up by this index arbitrage, and then it can unwind very, very quickly, right? And when it unwinds, all of a sudden, like, okay, there's trouble, right? Because all of these indexes are doing what they're doing automatically. The hedge funds can literally, just knowing what's going to happen, run arbitrage and run investments off that. But that's not necessarily good for markets. That's not necessarily good for the economy. So I think that we're seeing a lot of this going on where we've got a lot of stuff going behind the scenes, and the actual float in a lot of these stocks isn't very big. It's like looking at the volume traded, like a lot of that's just automatic. How much is really there? How much is really people saying, hey, look, I want to exit. Let me put that stock up for sale and see what price I can get versus, it being done by these indexes. And that creates a lot of potential volatility and a lot of way for the non-professional investors to get taken advantage of by the hedge funds and the professional managers. I've literally had a lot of people go out there and call passive investing evil. Like, these are well-known people, and they're saying that passive investing, which was supposed to be good, right? It was like you weren't making judgments. You were just investing in the overall economy, right? You weren't trying to play people off each other. That used to be the good investing, right? Now we're gotten to the point where it's the dominant, and there's a lot of stuff can get played off it, and people can get burned, right? I mean, you literally have giant stocks that have a lot of momentum behind them, and then when it flips the other direction, I won't name stocks because I don't like to name individual stocks. We've had individual stocks this year that have lost a, $1 trillion worth of value. I mean, if you think about it, that means that $1 trillion worth of value came out of a lot of passive investors in indexes and pensions, and they weren't, they weren't betting on that, right? So I think that, we've got to be very careful these days about, thinking that things are great, because I think there's a lot of head fakes with that. And I think that people need to be aware that, like, just because a stock is going up, And if it's in an index, and it's heavily bought in an index, if it's a couple percent of major indexes, like the passive market at work isn't necessarily going to be in your favor, right? Especially because a lot of the regulations and rule are written around cost. Indexes are lower cost, but just because something's lower cost doesn't make it a better investment. If cost made things the sole determiner of what was a good investment, the greatest investment in the world would be a savings account, right? There's no expense ratio. All you get is interest income, right? But we all know that savings accounts are generally a very bad investment, especially over the long term, right? There's just better places to put money. So that said, the other thing that I think people need to focus on a lot is the credit markets, right? The credit markets oftentimes dictate a lot of what's going to happen in the equity market. And we have been having very tight spreads in junk credit, the triple C's, and that's expanded a lot. And what we've seen is that the value being placed on those has gone down significantly, right? Well, that generally is precedes negative things in the economies and negative things in markets. So I'm always watching the credit markets to see how they are. If the credit markets deteriorate, I think the credit markets are much more in tune with reality and current reality than equity markets are, because the credit markets, these are things that have to have payments paid, right? There's payments being made every month. They're much more in tune with like, oh my God, like XYZ company, they were 5 days late. I mean, it was in the window, but they were 5 days late with their payment. Like, okay, in the traded market, let's drop that down. Let's not pay as much for it. These companies or stresses will show on their debt and the credit side before they'll show on the equity side. So right now, I think there's a lot of stress in the credit markets. If you look at where triple C's are trading in the high yield market, I think it's got to make you really, really question what's going to happen going forward in the equity markets. So that's kind of the other thing when I look at right now is we've got this issue with passive investing and arbitrage being run off it. And, even though there's a lot of exuberance that the economy is going to do great, and I will, readily say that I didn't think that the first Trump administration was going to do great things with the economy, and I was wrong. So I don't want to underestimate them again, but I'm looking at the credit markets and I'm thinking like, this doesn't look very good. And I also think that the Trump administration is less worried about what the economy looks like today and more likely to look at what it's going to look like in the next election cycle, which hasn't really started yet. So we got midterm elections, and I think they're looking for let's rip the Band-Aid off now and fix things, deal with the pain so that things are on an upswing the next time we have to go in front of voters. So I think you put all those things together, and I'd be pretty risk adverse right now.
That doesn't seem, though, like a big change from what you've been saying for a couple years now. I would have thought this was a sea change moment and very big changes would be needed.
Yeah, but I mean, people think that they're, especially with all of the political talk out there, like no president actually has dictatorial powers, right? A lot of stuff they can do their executive power, but a lot of stuff needs to be done through Congress, right? And the reality is that the Republicans in the House have like a very thin majority. It's like a couple votes, right? That means that it's going to be very difficult for them to do things because within the Republican Party, you've got ones that are just focused on cutting taxes, but you've also got a more fiscally conservative group out there that wants to bring spending down, right? And they if the choice is a spending cut or a tax cut, if we're going to have neither, they're better with that than doing anything that will explode the deficit any very higher. And they're going to look at CBO or Congressional Budget Office numbers, which historically haven't been good for predicting things, to be honest with you, but they're nonpartisan and there's something to point to. And so I don't think that the Trump administration is necessarily going to get everything that it wants through. And in fact, I think they're doing more stuff on the executive side because they know that on the legislative side, it's going to be a tough hoe to get a lot of stuff passed.
You always talk about taxes, Larry, and avoiding them. Tax mitigation is a big theme with you as a key to wealth accumulation. Since Trump is going to lower taxes, is that still true?
Well, as I was that's a good lead in for my last question, which is I really don't think that they have the ability to potentially lower taxes. I think they'll be lucky to get, to just extend the existing tax cuts. To get ones on top of that are any kind of substantive, I don't think will happen. And then, we've also got to talk about the issue of tariffs out there, right? Because they're kind of talking out both sides of their mouth on tariffs. Like, oh, we know tariffs are inflationary, and don't let anyone tell you that tariffs aren't inflationary, right? But the reality is that they're saying, oh, we're just going to negotiate and the tariffs won't really be there. Well, at the same time, they're saying, well, we're going to have all this income from tariffs in order to offset, these tax cuts. And so it's like, what side do you believe? Because it's depending on who you're talking to on what day. I think the bigger picture, though, is people have to understand what the real issue on tariffs is. The real issue on tariffs isn't like we want to go to war with all these other countries. I mean, I think that what the Trump administration doing is they're trying to reset entirely kind of the world trade picture, right? And if you take a step back and look at it historically, I mean, what happened was after World War II, most of the world was destroyed, right? And the U.S. was the only nation who had its manufacturing base intact. The rest of the world was bombed and destroyed and was just devastated, right? So we ended up doing the Marshall Plan, where we spent a whole bunch of money in order to build them up, right? And as they were developing their industry and as they were coming back, and as the Cold War started heating up, to kind of keep a lot of these countries on our side, we allowed them to put tariffs on our goods that we weren't tariffing on them, right? So the trade imbalances, a lot of that's been driven by the fact that trade hasn't really been fair to the manufacturing base in this country for 50 or 60 years, right? It was like, okay, we're going to allow them to protect their goods from ours because we need them to fight the Russians. We need them in the Cold War. We need their support. And now, like, the world has changed, right? Now it's like, okay, Europe, we're not going to allow you to, have all these protection of tariffs, and at the same time, allow you to just, give out tons of social services from your taxes because you're not spending any money on defense because you knew we would do it for you, right? We've been protecting all of these countries, and the new thing is like, no, we're not. The first Trump administration, had an agreement for all these countries to live up to their NATO agreement of 5% of GDP spent on defense, and none of them did it, right? This time, they're going to have to do it because we're literally saying we're pulling the troops out, right? You got this war in Ukraine, we've been carrying the full cost. And let's just be honest. The United States has borne the vast majority of the costs in Ukraine. Why? Because all the other countries lent money and equipment to the Ukrainians, and we granted money to them, right? If you look at the aid that's gone in, the percentage of grants in all these other countries is low or nothing. And, we've got $100 billion plus in grants that we've done to them, right? So we're saying like, hey, we can't, our economy is in troubles. We need to focus on our economy. We are going to make trade fair through tariffs, right? So if you tariff us, we're going to tariff you. And if you're a country that doesn't have our interest, we're going to tariff you. And we're going to make sure that all of these essential industries that we need in case of a war, like we literally can't be saying, hey, look, China, we're going to force you to not invade Taiwan. And by the way, still send us all the drugs we need for our pharmaceutical cores. Like, you can't do that, right? So we're going to bring a lot of manufacturing back, even if it's not the best place to manufacture it, on the basis of that we need it in case we get into a war. That's the copper, that's the aluminum, that's the steel industry, right? We're bringing those all back to the U.S. We want it done here because we need to be able to have a war machine in case we get into a world war where we're self-reliant and we don't need to buy inputs for whatever we need to run our economy, whether it's war or civilian, from our enemies, right? So there's a big reset being done. So first of all, that is highly, highly inflationary, right? Because, but at the same time, we've got to restore our manufacturing base in this country because it's not there, and we can't, continue to run these massive trade surpluses because we don't have the money to do it. We're, if you add municipal, state debt in with federal debt, I mean, we're, 46, 47, 48, $50 trillion in debt, right? That's not, when you're $50 trillion in debt, you know what they're saying? When you're in a hole, stop digging. we've got to stop digging. Otherwise we're going to destroy our economy. And the fix for it is going to be really, really painful. But the Trump administration saying we acknowledge that and we do that. And what you care about, whether you like or dislike Trump or all that stuff, that's kind of irrelevant. He wants to reset how the world economy works, and he feels he has a mandate to do it, and he's doing it, right? We're on a lot of policies. It's like, I don't know what the rules are, but we're going to push it, and you have to dial us back, right? And I think in some areas he's going to have the right to do it. In other areas he's not. But, a lot of politicians and stuff have gone on all over this country where it's like, I'm going to do it, and, you stop me, right? And that's where Trump is on a lot of this stuff. Good, whether the policies are good or bad, it's kind of reality. And so when you're sitting there, like, that is a sea change, right? But just because we see the problems and now we're addressing them, we're still on this giant ship. It's still got to get dealt with. So all of these problems that are in the economy that maybe now we're being realistic about are still there. Just because we're realistic about it doesn't mean we easily fix them. And the fixes are really difficult, right? And so it may be marginally better that we're realizing we have a real debt issue, and the economists that have influence in this administration think that debt matters, as opposed to prior administrations of both parties where they didn't think the debt really mattered. But now that we're there, like, we're still, we still got to deal with these things. We still got to fix them. And that means that, if your investment philosophy has changed significantly in the last year, well, then a year ago, you didn't see what the debt was doing. You didn't see what inflation was doing. You didn't see what all these policies were causing. And if you have to adjust now, then you weren't on it then. So my kind of feeling is, like, if you're making massive change in the less investment ideas now, then you were oblivious to what was going on a year ago, because the problems now we may be more honest about them, but they were already there, and you should already have been thinking about that. Now, that said, a lot of stuff that has been working is going to continue to work, and some of the volatility is creating some opportunities to go into things that we know are going to be higher, just based on global economics 3, 4, 5 years from now. So I'm not saying go and hide under your mattress. I think the exact opposite is you've got to be proactive, and you've got to go invest with, what I like to say is my Wayne Gretzky approach, which is that, I don't want to look in the back mirror and say, hey, this is done best last year, therefore let's invest in that. I'm saying, hey, look, this may be down right now. That's an opportunity because I see what's going on in the economy, and these things are going to happen. And therefore, I don't know if I'm in early or late. That's why we tend to move into things slowly. We chip in, to use a golf or sports analogy. But I'm looking at it and saying, hey, look, there's still 1 billion people in China that are going to want cars, and there's still 1 billion people in India that want air conditioning. So even though the global economy may be negative right now, those people are going to get that, right? So let's invest in the things that go into that. That's kind of the philosophy of where we're going right now.
Finally, Larry, baseball season is upon us. You're a big sports guy. You live in Southern California. The Padres had a very good team last year. Dodgers World Series champions. They're calling this year's team maybe the greatest team of all time. Who knows? But how excited are you for this season?
So I'm going to be honest with you. I'm most excited about the Marshall Fundamental Eagles baseball season coming up, and especially when my son's on the bump pitching. So, that's my focus there. But, we are a big sports family, and, we're going to, take a trip. My son and I will take a trip to the All-Star game again this year. We're going to go see some other baseball parks. We're going to play a lot of baseball. But I'm excited about the baseball season. And, I'm born in St. Louis. I don't think my Cardinals look that good this year. It's definitely rebuilding. And it's uncharacteristic that they're having multiple rebuilding years in a row. For forever, they would go from first place to last place and then back to first place. They've had a couple rough seasons. But, the one that's really closest to my heart was I grew up in San Diego, a diehard Padre fan. I had an opportunity as a kid to know Tony Gwynn and have him work with me some as a baseball player as a kid. And, the Padres are just my guys. And it's just difficult to see what the Padres organization is going through right now. But, there is actually some relevance to, what I do in that, oftentimes I have clients who, one generation unfortunately goes and the next generation's got to take over. If you haven't done proper planning and you don't have that arranged, you end up in the situation the Padres are at. And I know that not everybody here is going to be an expert on the Padres, but the owner died, and now there is a court battle over control of the team between the original owner's siblings and his wife, right? And they're fighting over who's in control of the team. And it's made it difficult for them to sign players, and it's made it difficult for them to create stability in the franchise. And then, like, right before the season, we have a couple key players with injuries, so that's going to be tough, to see. But my son will definitely enjoy it because growing up in LA, he is diehard Dodger fan, and we go to lots of games, and it's just fun for him. So I'll wear my Dodgers gear as long as they're not wearing the Padres or the Cardinals, but I'll still be watching the Padres score more closely, even if I'm at the Dodger game.
Tony Gwynn, the all-time basketball leading scorer at San Diego State. And if you go back to 1994, the year that there was a strike, I believe he was batting .394, and he was a legitimate threat to Ted Williams' record of .406. And then they went on strike that year, and the rest of the season was canceled. But he clearly, top 2-3 hitters of all time.
No, he's the top hitter. He's the greatest hitter that ever lived. And, the thing about it right now is, it's rare that anybody hits 300, right? And there's a couple players out there right now that are around that 300 career mark. And there's actually discussion that, Freddie Freeman and Trout should, how are they going to be able to keep their average? I think they're both 299 career right now. Are they going to be able to continue playing and not have it drop under 300? And I think Arise is also a career 300 hitter, but he's very early in his career. We may have now seen the last time anybody hit 300, let alone 400, right? But that's just because, anybody that knows my generation and knows our dads knows that oftentimes baseball was something that we would, even when, I know this is parroting a line from a famous movie, but even when we had difficulty dealing with our dads, even when we had difficulty in those relationships, we could still talk baseball, right? And I really have that with my son, which is that even when he's not happy with me, even when, the disciplines had to kick in because of whatever reason has happened, there's still the Dodger game we want to go to together. So, and there's still the All-Star trip that we do every summer. So, we still have that. So that's important to me because at the end of the day, I am focused on business, but I'm still focused on my kids first.
Larry Steinberg. I am Evan Markovsky. Larry is the Chief Investment Officer and Partner at Financial Architects. Thanks so much. This is the Financial Architects Podcast, and we will see you on the next episode.